What's up guys, it's Christian. Welcome back to another video. So today I want to talk about the jobs report that came out on April 7th, the release of the CPI information on April 12th, the release of the Federal Reserve's meeting minutes from last month's meeting also on the 12th, earnings for major banks on the 14th, and the impact on the Federal Reserve and how you can stand to make a lot of money from this situation. So the jobs report came out on April 7th, and while it did have some good news, it did create some uncertainty among investors. One of the main points from the job report was the creation of 236,000 jobs, which is historically decent, but does represent the smallest month-over-month gain in the past 2 years. The most significant increase was in the sectors of restaurants, bars, and hospitals, with jobs being lost in construction, manufacturing, and retail. Unemployment also dropped to 3.5%, while hourly wages increased 4.2% year over year, representing the most minor level of growth since mid-2021 when inflation was surging. These results indicate some level of uncertainty in the market and probably will affect the Federal Reserve's decision to keep interest levels where they are or raise them at their next meeting on May 3rd. Specifically, with a steady increase in job creation over the past couple of months, this indicates that the job market and economy continues to grow and suggests to the Federal Reserve that another interest hike might be necessary to slow the growth of the economy and bring inflation back down to its 2% goal. In terms of the slow wage gain, this is the opposite signal to the hiring data, as slow wage gain demonstrates a slowing or stagnating economy. This is because when wages increase slowly over time, it demonstrates that employers are not desperate to retain the people they have or get new employees there, which is a sign of slowing economies. This comforts the Federal Reserve as it indicates that the rate hikes they've been doing over the past couple of months may have been effective in slowing the economy, which might bring the inflation down to their target. Overall, the report demonstrates a resilient labor market that's less desperate to hire new people as indicated by the wage stagnation. However, it does demonstrate the market is still growing, and so the Federal Reserve will have to look at this and decide if future rate hikes are necessary or not. This result is confirmed by the CME Federal Watch tool, which predicted there to be a 49% chance that the Federal Reserve was going to raise interest rates in the next meeting before the jobs report came out, and increase to 72% after the report came out. The second big thing that's come out this past week has been the CPI and core CPI information, which came out on April 12th. The CPI tracks the prices paid by consumers for goods and services, with the core CPI not including the volatile prices of food and fuel into its calculations. Because it doesn't take into account the more volatile price of food and fuel, the core CPI is kind of indicated to be a more realistic or more accurate representation of inflation and is kind of used preferentially over the CPI for inflation measurements. The CPI was expected to increase by 5.5% month over month, while the actual value was a little bit lower at 5%. This is down from 6% in February and represents the slowest increase in CPI since May of 2021. The core CPI was expected to come in at 5.6%, and it did come in at that expected 5.6 value, which is slightly higher than 5.5 in February and represents the first acceleration in core CPI since September of 2022. And if you remember, the CPI includes the volatile prices of food and fuel in its calculations, which have fallen dramatically over the past couple of weeks. However, the CPI data also demonstrates a significant increase in inflation in airline fares, transportation services, as well as service costs, such as rent, hotel rooms, manicures, insurance, and childcare. So the decrease in food and fuel prices, in addition to the increase in transportation and airline fares, demonstrate why the core CPI increased while the CPI actually fell, and further explains why the Federal Reserve prefers the core CPI metric instead of CPI for their measurements of inflation. However, as the core CPI increased month over month, it demonstrates to the Federal Reserve that inflation isn't fully under control yet, and thus pressures them to increase rates at their next meeting. The second big event on April 12th was the release of the Federal Reserve's meeting minutes from last month's meeting on March 21st and 22nd. The major headline from these meeting minutes was that the Federal Reserve believes there's a high chance of a recession happening later this year with a subsequent recovery over the next 2 years. This is mainly a result of the banking turmoil caused by the collapse of a few banks last month and the tighter lending practices they're putting into place, which the Federal Reserve fears might slow the economy and push it into a recession. However, there does seem to be some disagreement inside the Federal Reserve, with different presidents of banks having different opinions on whether an interest rate hike is even necessary or not. John Williams, the president of the Federal Reserve Bank of New York, said the Fed had more work to do and suggested a 0.25% rate increase was a reasonable starting place. Conversely, Andrew Goolsbee, the president of the Federal Reserve Bank of Chicago, was concerned about the recent bank failures, suggesting they need to be more cautious and gather more data before raising interest rates too quickly. Finally, Mary Daly, the president of the Federal Reserve Bank of San Francisco, said there was a good reason to both keep rates as they were, but also to increase them. These quotes demonstrate great uncertainty in the Federal Reserve regarding its next steps to curb inflation. Additionally, the Federal Reserve isn't the only central bank that's having questions about whether or not a rate increase is necessary and whether they should pursue it or not. The Reserve Bank of Australia decided to halt its rate increase at 3.6% after reports of falling inflation in Australia in early April. Conversely, its neighbor New Zealand is still going full speed ahead with its interest rate hikes, raising rates by 0.5% on April 5th. This disagreement on whether or not to raise interest rates, both in the US and globally, signals a great deal of uncertainty in global financial markets in regards to inflation, how to control it, and the role of interest rates in all of this. Following the CPI and Federal Reserve meeting minutes released on April 12th, stocks and bonds didn't really move much, as they felt that the CPI and the results of the meeting minutes were kind of in line with expectations and didn't really ruffle any feathers or surprise anyone too much. Additionally, the CME Fed Watch tool dropped their predictions for increasing rates from 73 to 67%. The last significant event I want to discuss today is the release of earnings from a few major banks in the US on April 14th. All the way back in January, before the Silicon Valley Bank collapse in March, banks have been tightening their lending practices. And since January, the economic conditions have not improved at all since Silicon Valley Bank and a couple other international banks have collapsed. Thus, the reports and the results from these earnings were highly anticipated and expected to be major factors in the Federal Reserve's decision to raise or keep interest rates as they are, with the speculation being that good earnings reports will bring confidence to both investors and the Federal Reserve, while poor earnings will push people away. Specifically, earnings may affect both investors and the Federal Reserve, who will adjust their investment strategies and monetary policies accordingly. The major banks that reported earnings was JP Morgan Chase, Citigroup, and Wells Fargo, which all beat expectations and saw upticks in their stock price. Specifically, JP Morgan Chase was up 7.55%, Citigroup climbed 4.8%, and Wells Fargo traded sideways after rallying earlier in the day. Rising interest rates catalyzed much of this profitability in these banks, with higher interest rates resulting in higher profitability through banks through their loans, at the cusp of profitability through paying depositors their interest. However, the earnings were not all good for these major banks, as they saw changes to their inflow and outflow of deposits. JP Morgan Chase did see a 2% increase in the number of deposits in Q1. However, they fell behind Q1 of 2022 by about 3%, which means while they saw an increase in the number of deposits in the past couple of months, the rate of that increase is slowing down. Following these earnings from banks, the CME Fed Watch tool increased the probability that they would see an increase in interest rates the next meeting from 67% the day before the earnings came out to 78% after the earnings came out. So ultimately, while the results of the banking earnings were generally positive, the details of the release have not been good for the stability of the economy and may suggest to the Federal Reserve that future increases are necessary. So taking the combined results of the employment data, the CPI, the Federal Reserve meeting minutes, and banking earnings, what can you do with all this information to make money? Before we start on that, I just want to quickly say I am not a certified financial advisor, and this is not financial advice. It simply serves to provide my own opinions on market conditions and opportunities and strategies that interest me. You should do your own research before making any investment decisions, as investing is inherently risky. A major takeaway from all this information is there's a great deal of uncertainty in the financial markets right now. Specifically, the creation of new jobs contradicts the slowing in wage growth that we saw with the report. The core CPI increase demonstrating that inflation is still very present and is a significant problem. The Federal Reserve has internal disagreements on whether or not an interest rate hike is necessary or not, with it all culminating in the banking earnings report, which on the surface seems good, but the details kind of paint a different story of a struggling financial system, all resulting in the CME Fed Watch tool predicting an 80% chance the Fed will increase the rates at the next meeting on May 5th. In times of uncertainty, the types of assets that increase in value are the ones that are considered as stable and safe in the economy. The two major sectors in which I see most benefiting from this uncertainty are precious metals and cryptocurrencies. That's why my suggestions for today are to buy into precious metal stocks and cryptocurrencies to take advantage of the increased uncertainty, which consequently will lead people to buy into assets that they believe are more safe and a better store of long-term value. In regards to precious metal stocks, the stock tickers I think you should look into are NUGT, UGL, and AGQ. NUGT is a 2x leveraged ETF tracking the price of gold producing companies. Over the past month, NUGT has increased by 30% and over 106% in the past 6 months. As uncertainty continues to grow, companies that produce gold, the standard for safe storage of wealth, will grow in value, resulting in increased stock prices for this ETF. UGL is a 2x leveraged ETF that tracks the price of gold itself. Over the past month, UGL has increased by around 2% and around 41% in the past 6 months. For the same reason as NUGT, UGL will likely continue to grow in price as uncertainty continues, especially if interest rates are raised at the next Federal Reserve meeting. Finally, AGQ is a 2x leveraged ETF that tracks the price of silver. Over the past month, AGQ has increased by 27% and over 77% in the past 6 months. Like gold, silver is a standard value storage and benefits from increased market uncertainty. Additionally, silver is a common component in electronic products, such as electric cars and solar panels. So, if you believe in the future of EVs and solar technology and that the financial uncertainty will continue, AGQ may be a good option for you. So, if gold and silver are the standard boomer suggestions for hedging against inflation, then cryptocurrency is the Gen Z relative. For the same reason that gold and silver have increased with market uncertainty, cryptocurrencies have also seen price increases as people flock to more stable and decentralized forms of value, less reliant on the US Federal Reserve and the market conditions in the US economy. And unsurprisingly, the price of Bitcoin and Ethereum have increased in the past couple of months as a result of the uncertainty in the financial markets. Specifically, Bitcoin has increased in value by 22% in the past month and nearly 60% in the past 6 months. Similarly, Ethereum has increased by 27% in the past month and is up over 63% in the past 6 months. All these assets are posed to increase in value if the uncertainty in the markets continues or if the Federal Reserve agrees to raise interest rates at their next meeting. Of course, buying leveraged ETFs, as I have highlighted, is risky and should only be done by investors that understand the risks associated with them and are prepared to take those risks. But while not financial advice, all of these assets that I've brought up have the potential to increase in price as a result of the geopolitical and macroeconomics events that are currently happening. And such, I wanted to bring these opportunities to your attention so you can potentially profit from these upcoming events. Well, that's all I have for today. Thank you so much for watching. Please let me know what you think in the comments down below, and consider liking and subscribing if you haven't already. I really appreciate it. Thank you, and I'll see you next time.